Let's talk about California's net operating loss dedication suspension, navigating tax changes. We all know that the NOL, the full name is net operation loss. It is a good thing for us to take the advantage of the loss to cut down or to reduce the tax for ourselves. For example, the corporation tax if you earned a little but you lost a lot. For example, if you are an individual, you earn your salary, your wages too little, and you cost a lot. That is means that you have NOL, the net operating loss. This NOL can be used in the next year, but it has been changed since California gave a new act. Let's see what's happening. California has enacted significant changes to its net operating loss dedication rules for tax year 2024 to 2026, presenting new challenges for business and individuals across the state. This substantial of NOL dedications aims to boost state revenues while preserving long-term NOL value through extended carryover periods. As we delve into the implications of these changes, it's crucial for California taxpayers to understand the nuances of the new legislation and the development strategies to navigate this shifting tax landscape. Let's continue. The background on California NOL rules. First is a pre-2004 NOLs. California had specific rules for NOLs generated before 2004, including limited carryover periods and restrictions on usage. And the second period is 2004 to 2007 NOLs. Rules were updated for NOLs generated between 2004 and 2007, introducing new carryover periods and dedication limitations. And the next is post-2008 NOLs. And the fourth is 2020 to 2022 suspension. California temporarily suspended NOL dedications for these tax years due to budget constraints, while exceptions for small business. And the new legislative changes for 2024 to 2026, suspension of NOL dedications. California will suspend NOL dedications for tax years 2024, 2025, and 2026 for taxpayers with net business income or modified adjusted gross income of 1 million or more. That means if your gross or income is more than 1 million, you do not have the right to join the NOL. And the second is extended carryover period to compensate for the suspension. The carryover period for suspended NOLs will be extended by 3 years, preserving their future value for taxpayers. And small business exceptions, taxpayers with income below 1 million will still be able to apply their NOL dedications during the suspension period, providing relief for smaller entities and potential early sunset. The legislation includes provisions for potentially ending the suspension early if certain state revenue targets are met, adding an element of uncertainty to long-term planning. and these implications for California taxpayers. And the first is the financial impact. The suspension will likely increase tax liabilities for affected business and individuals during 2024 to 2026. This could result in significant cash flow challenges, particularly for companies relying on NOL dedications to manage their tax obligations. Careful financial modeling and projections will be crucial to understand and prepare for these impacts. And the strategic planning. Taxpayers need to assess their tax strategies, potentially exploring alternative methods to minimize tax liabilities during the suspension period. And this might include accelerating dedications, deferring income recognition where possible, or maximizing available tax credits. Long-term planning should also account for the extended NOL carryover periods and how to optimize their use post-suspension. Compliance considerations. The new rules add complexity to tax compliance. Affected taxpayers must ensure accurate tracking and documentation of their NOL positions, including the extended expiration dates for carried over losses. Staying informed about potential early sunsets or additional changes to the legislation will be crucial for maintaining compliance and optimizing tax positions. And practical guidance for navigating NOL changes. The first is consult tax advisors, and the second is update financial projections, and the third is explore alternative strategies, and the fourth is plan for future optimization, and the fifth is monitor legislative developments. And let's give a real example of the example is just like this. Let's see if a company called ABC that is based in the California tax liability and assumes that the taxable income is 5 million per year from 2024 to 2026, and the available NOL carry forward is 4 million, and the California tax rate is 8.84%. And without NOL suspension in 2024, it will pay 5 million minus 4 million and times 8.84 equals to 88,400 tax. And in 2025, it will pay 442,000, and in 2026, it also equals to 442,000 tax. And without the NOL, the 4 years totally paid for the government to $972,000. And if the act is still available and with NOL suspension, it will cost, for example, when the NOL suspension, it will cost the every 3 years, it equals to 5 million times 8.84% equals to 442,000 US dollars per 3 years, and it totally equals to 1 million and 326,000 US dollars. And we can combine these two facts that with NOL suspension, it's more than $353,000 than without NOL suspension. So this is a very hard burden for the company to to adjust or to apply for the act. And we can also see that uh, the we can compare the suspension and let's see the taxable year 2023 in California form. It will fulfill the tax in this period. You can see it's 2025 current year NOL, and it is based on the individuals and estates and trusts. It's the individual California form, and it will be fulfilled in this basket. But actually, it has another corporation California form, and it is be filled in this net cap and cap of NOL. It will be filled in this period. So this is the 2023 NOL dedication. It's difference between the individual California form. But we can see it can be used to your tax in 2023, but it has been suspended just now. So I think that it make a burden to the individuals and to the corporations. That's all. Thank you.